Here's the most crowded trade in 2026. Everyone who figured out AI was real, bought Nvidia, felt smart, and is now sitting on a stock that's already priced for perfection. That's not a position. That's a waiting room. The problem with obvious trades isn't that they're wrong. It's that by the time they're obvious, the upside has already been distributed to the people who were early. You're not early anymore. So the real question isn't which AI stock to own. It's which companies are actually capturing AI spending without being priced like a religion. That's a different question, and it leads to very different answers. 3 companies, 3 distinct ways the AI boom converts into earnings. None of them are what most people are watching right now, and that's precisely the point. Before we get to the names, let's establish why 2026 specifically demands a different lens. Because the market has shifted and most investors haven't noticed yet. Here's where we are as of early 2026. The S&P is up, but narrowly. Capital is rotating away from pure AI story stocks toward the companies actually building the infrastructure those stories depend on. The hype phase didn't end, it matured, and maturation is a different game. The Fed is easing, but cautiously. GDP is growing at 2 to 2.5%. Inflation is sticky enough that nobody's calling this a full pivot. What that adds up to is not a risk-on environment, it's a selective one. The market is asking a harder question now, not which companies have the best AI narrative, but which ones have a clear, visible path from that narrative to actual earnings. That filter matters, because the AI build-out is real and it's enormous. Hyperscalers are committing somewhere between $500 and $700 billion annually to AI infrastructure, and that number is still climbing. Data center power demand is on track to double. These are projections based on optimism. They're contracts, CapEx commitments, physical construction. So here's the question worth sitting with before we go further. When $500 billion flows into AI infrastructure every year, where does it actually go? Not all of it goes to the most famous chip company. A lot of it goes somewhere less visible and less crowded. The first company on this list sits at exactly that bottleneck. Broadcom is not an AI company in the way that phrase usually gets used. It doesn't build the models. It doesn't run the clouds. What it does is design the custom silicon that makes those models possible. Chips built specifically for Google, Meta, ByteDance, Microsoft. And it does this at a level of integration that makes replacement not just difficult, but economically irrational. That's the core of the story. And it's a different kind of story than most AI trades. The numbers behind it are not subtle. Q1 FY 2026 came in at $19.3 billion in revenue, up 29% year over year. AI semiconductors grew somewhere between 106 and 140% in that same period. Q2 is guided at $22 billion, up 47%. CEO Hock Tan said on the March earnings call that AI chip revenue will exceed $100 billion by 2027. That's not a vision statement. That's a backlog with a timeline attached to it. There's a meaningful difference between those two things. The moat here is switching cost, and it's worth being precise about what that means. Broadcom's custom ASIs are designed into its client systems at the architecture level. Walking away from that relationship doesn't mean finding a new supplier. It means rebuilding years of chip design work from scratch, absorbing the delays, and accepting the performance gap in the interim. For a hyperscaler running AI at scale, that cost is measured in billions. So the relationship holds, not out of loyalty, out of math. On valuation, 31 to 35 times forward earnings sounds expensive until you put it next to 40% plus earnings growth and a free cash flow yield of around 4.5%. That yield figure is unusual for a company compounding this fast. JP Morgan has it at overweight with a $500 price target. Morgan Stanley is at $470. Goldman has it on the conviction list. Consensus upside sits in the 35 to 40% range. The margin of safety entry, based on current fundamentals, is somewhere below $310. Now the risks, and they deserve plain language, not a footnote. China exposure runs between 17 and 30% of total revenue, depending on how you count it. That's not geopolitical color. Under serious tariff escalation, you're looking at 5 to 8 points of margin erosion. That's a real number with real consequences for earnings. Then there's client concentration. 4 hyperscalers account for roughly 45% of Broadcom's AI revenue. If Meta or Google pulls back CapEx by 10%, not collapses, just trims, Broadcom absorbs a $2 to $3 billion revenue hit. That scenario doesn't require a crisis. It just requires a cautious earnings call from one of its 4 largest customers. These aren't reasons to avoid the stock. They're reasons to size the position with discipline and know exactly what you're monitoring each quarter. Broadcom owns the custom chip layer of AI infrastructure, but chips generate heat, and heat requires power, and power requires infrastructure of a different kind entirely. That's where the second company comes in, and almost nobody is talking about it the way they should be. Nobody builds a data center without Vertiv. They just don't talk about it. Cooling systems, power distribution, liquid cooling for the high-density GPU racks that generate enough heat to shut down a building if you get it wrong. This is the infrastructure underneath the infrastructure. Unglamorous, load-bearing, and essentially impossible to skip. When a hyperscaler breaks ground on a new facility, Vertiv is already in the supply chain before the first server arrives. The numbers make that dependency legible. Q4 2025 orders were up 252% organically. The backlog hit $15 billion, doubled. The book-to-bill ratio came in at 2.9 times, which means for every dollar of product shipped, $2.90 of new orders came in behind it. FY 2026 guidance calls for $13.25 to $13.75 billion in revenue and 43% EPS growth. This company has more than 2 years of visibility locked into its order book before a single new sale is made. Here's a question worth sitting with. If you knew a business had $15 billion in committed orders and a 2.9 times book-to-bill, would your first instinct be to call it risky? Probably not. But this is where the nuance lives. Because guaranteed demand and guaranteed execution are 2 entirely different things. Vertiv's risk isn't on the revenue side, it's in the delivery. Supply chain delays on transformers and critical components have historically run 3 to 6 months. When that's happened before, the stock dropped 15 to 25%. Not because the orders disappeared, because the timeline slipped. At a valuation of 38 to 44 times forward earnings, there is no margin for that kind of disappointment. The premium is pricing in flawless execution. That's a high bar. CEO Dave Coate spent over a decade running Honeywell and built it into a compounding machine through operational discipline. That pedigree matters here because the constraint isn't demand, it's throughput. Whether his playbook translates to this scale, at this speed, is the real variable to watch. 2 other risks deserve plain language. First, grid delays. Roughly 20% of data center projects are pushed into 2027 because power infrastructure can't keep up with construction pace. That's not Vertiv's fault, but it directly affects when backlog converts to revenue. Second, the hyperscalers aren't passive observers of the margins Vertiv earns on their infrastructure. The risk of partial insourcing is real. Not imminent, but a 10 to 15% market share exposure over a 3 to 5 year horizon is worth holding in mind. Goldman has a price target of $277. JP Morgan is at $305. Entry discipline starts below $220. Vertiv and Broadcom are both AI infrastructure, but they're correlated to the same cycle. If hyperscaler CapEx compresses, both feel it. The third pick is built on completely different ground. It doesn't care what happens to GPU demand. It's solving a different problem entirely. one that's been building for a decade and isn't going anywhere. Eli Lilly doesn't belong in an AI portfolio. That's the right instinct, and it's also exactly why it belongs in this one. The portfolio built around secular megatrends doesn't have to be a single-theme bet. And the obesity and diabetes drug market is as structural a shift as anything happening in semiconductors. Mounjaro and Zepbound are not trend drugs. They're not riding a cultural moment. They represent a genuine change in how medicine treats a condition that affects hundreds of millions of people and has resisted effective intervention for decades. The market is projected to exceed $100 billion by 2030. Lilly is the leader. Its patent coverage runs past 2030. That's not a short trade dressed up as a long one. The numbers don't require interpretation. Q4 2025 revenue came in at $19.3 billion, up 43% year over year. FY 2025 closed at $65.2 billion, up 45%. FY 2026 guidance is $80 to $83 billion. That's a company growing faster than most pure-play tech names at a valuation, forward PE around 29 times, that prices in less optimism than either Broadcom or Vertiv. That gap is difficult to explain rationally, which usually means it's an opportunity. The pipeline adds another layer. Orforglipron, an oral GLP-1 drug expected in 2026, removes the injection barrier that has kept a meaningful portion of the eligible population on the sidelines. Pills versus injections is not a minor product distinction. It's an addressable market expansion. On competition, Novo Nordisk is real and shouldn't be waved away. But it's trailing Lilly by 12 to 18 months on both pipeline development and manufacturing scale. The price war already visible in Europe is the risk to watch. Margin compression of 5 to 10% is a plausible scenario if that dynamic crosses the Atlantic. Medicare pricing pressure under new U.S. legislation adds another 8 to 12% realization risk on top of that. These aren't tail risks. They're the known friction inside the bull case, and they should be held there, not ignored, not overweighted. What makes Lilly structurally different in this portfolio is its behavior under stress. Low beta. Demand that's proven sticky even in economic slowdowns. People don't stop treating chronic conditions when the market turns. That's the hedge. Not explicit, not mechanical, but real. Morgan Stanley has a price target of $1,313. Consensus sits at $1,220 to $1,250, implying 23 to 26% upside. Margin of safety entry begins below $850. 3 picks now. 3 distinct growth engines, 3 different risk profiles, 3 different relationships to the broader economy. The question worth asking is whether they actually work as a system, or whether this is just a list with a thesis stapled to it. The 35/35/30 split isn't a formula. It's a risk-weighted argument. Broadcom and Vertiv are both AI infrastructure, but they don't carry the same risk. Broadcom's exposure is at the design layer, custom silicon, long-term contracts, switching costs measured in years. Vertiv's exposure is at the physical layer, cooling, power, execution against a backlog. Same tailwind, different failure modes. Holding both isn't doubling down on AI infrastructure. It's owning 2 different bets within it that don't break on the same trigger. Lilly is the structural counterweight. It has no meaningful correlation to hyperscaler CapEx decisions. If Meta pulls back spending and AI infrastructure names reprice, Lilly doesn't care. That's not an accident of portfolio construction. It's the point. The base case return of 40 to 55% in 2026 requires 3 things to hold simultaneously. Hyperscaler CapEx stays firm or grows. Vertiv executes on its backlog without a supply chain disruption. And Lilly defends its pricing against Novo and regulatory pressure. If one of those breaks, the upside compresses. It doesn't collapse because the 3 positions aren't correlated failures. One leg can bend without the structure falling. 3 things to monitor every quarter without exception. AI CapEx signals from Meta and Google earnings calls, Vertiv's backlog conversion and power grid news, and Lilly's pricing dynamics against Novo in both Europe and the US. These are the canaries. If any one of them starts signaling deterioration, that's not a reason to panic. It's a reason to revisit the position sizing. Here's the question worth answering honestly for yourself before you put capital behind any of this. If you had to cut one of these 3 positions tomorrow, which one would you remove and why? The answer isn't about which company is weakest. It's about which risk you're least equipped to hold through. There's no wrong answer, but not knowing your answer is how you end up selling at exactly the wrong moment. The logic is laid out. One thought left. None of these 3 picks are bets on which technology wins. They're bets on which companies get paid while the winner is still being decided. That's not a subtle distinction. That's the difference between speculation and investment. Everything in this video is for educational purposes only. It's not financial advice, and it shouldn't be treated as a substitute for your own research and judgment. These are my conclusions from the analysis. Yours may differ, and they should, because it's your capital and your risk tolerance on the line. Do the work, then decide.